This
How's
night,
up to you, sir?
we thank God. And yours?
Yes. Thank God, sir.
Okay. So
Welcome,
this
sir.
night, we are going to look at tax planning, tax audit, and tax investigation. Tax planning, tax audit, and tax investigation. We start with tax planning. What do we understand by tax planning? Tax planning simply means the process of arranging the taxpayer financial or business affair in a way that minimize or deferred tax liability within the tax law. What tax planning means is a conscious effort made by a taxpayer in order to reduce his tax liability within the contents of the tax law. What are the steps? What are the policy company need to put in place in order to reduce their tax liability without breaking the tax law? That is what tax planning talk about. This tax planning is very important in an organization. Every organization will have a tax planning document or tax planning manual, what they use to plan their tax. We are in tax planning. We are not saying taxpayer will not pay tax, but taxpayer will pay tax, but is going to pay tax at a minimum rate. Is going to pay tax at a reduced rate. Is going to take a lot of advantage of those different tax incentive, tax exemptions, all those kind of things. Take for instance now, as an individual, you as an employee, you are expected to pay personal income tax, payee. If you want to reduce your personal income tax, what are the planning you need to do? One of the planning you need to do is by increasing the rate of your pension contribution. The law makes it mandatory that an employee must contribute a minimum pension of 8% of basic housing and transport. But you can decide that you want to do more than the minimum. You can say, okay, out of my salary, 20% of my basic housing and transport should be used for my pension contribution, or 30%. By doing that, you are reducing your personal income tax. You are reducing your tax liability. So that is what tax planning ensure. You identify opportunities. The process of identifying opportunity such as tax relief, exemption, tax incentive, and take advantage of those opportunities in order to reduce tax liability. It is tax planning. Now, what are the tax planning checklists? What we are saying now is if a company wants to do a tax planning, what are the content of those tax planning? It is called tax planning checklist. So what are the things that you must contain in your tax planning manual? One of the content of tax planning checklist is called the list of approved taxes and levy. While doing your tax planning, you must state out all the taxes and levies that you want to pay, all the approved taxes and levy that you want to pay. You must state it out clearly. This company, no, we are going to pay company income tax, we are going to pay education tax, we are going to pay police development levy, we are going to pay value added tax on our goods sold. All the taxes and levies that the company is expected to pay, up to the local government taxes and levy called tournament rate, radio and television license, you must list it out. Is one of the content of your tax planning. Another one, timing of fixed asset acquisition. You need to determine the time that you need to acquire fixed asset. You need to time your fixed asset acquisition. Why do you time your fixed asset acquisition? In order to be entitled to what? Capital allowance. So timing of fixed asset acquisition is very important. In a year, when you have too much of profit, you can decide that let me buy fixed asset, let me purchase fixed asset. So that if I purchase this fixed asset, I will compute capital allowance on them, it will reduce my tax liability as a company. So timing of fixed asset acquisition is one of the tax planning checklists. Another tax planning checklist, timing of fixed asset disposal. What time do you dispose your fixed assets? You can dispose your fixed assets in order to take advantage of balancing allowance. Balancing allowance to also reduce your profits. So it's part of tax planning checklist. Another tax planning checklist that we have is called timing of capital allowance claim and amount to be claimed. You time the amount of capital allowance you want to claim. You restrict your capital allowance to 2/3 of assessable profit. When you don't have enough profit, you restrict your capital allowance. It's part of tax planning checklist. Another tax planning checklist that we have is called payee properly deducted. Monthly deduction of payee from staff salaries is one of the tax planning checklists. Monthly filing of tax return. What time do we file our tax return? We put it in our tax planning checklist. Let's say, for instance, value added tax is filed 21 days of the following months. Why personal income tax is filed 10th of the following month. Company income tax is filed 6 months after the end of the year. So you put it as part of your tax planning. You plan when you're supposed to file your tax return. You plan for that. Timing of fixed asset acquisition is very important. Another one, withholding tax properly deducted. Deduction of withholding tax on your transactions, on some payment voucher. You need to put it in your tax planning. What rate do you need to deduct? What are the transactions subjected to withholding tax? What are the transactions exempted from withholding tax? All this must be stated clearly in your tax planning checklist. Another one. Contribution to National Housing Fund is part of tax planning checklist in order to avoid penalties and interest. Contribution to National Social Insurance Trust Fund, NSITF, is part of tax planning checklist. Consider current tax incentive too. Is part of tax planning checklist. Location in export processing zone is part of tax planning checklist, or free trade zone is part of tax planning checklist. Export processing zone allowance. When you are a company, you are located in export processing zone. When you produce and you export goods within that zone, those goods will be exempted from tax. It is part of tax planning checklist. Pioneer company or take advantage of pioneer legislation is part of tax planning checklist. All these are tax planning checklists. So you consider exempt income or profit exempted is part of tax planning checklist. Distribution of dividend, which is treated as frank investment income, is also part of what? Tax planning checklist. So this is what we have on tax planning. This is what we have on tax planning. So let's look at tax audit. What do we understand by tax audit? Tax audit is a specialized audit. It is the review or review of book and record of a taxpayer by the tax official, by the relevant tax authority. The examination of book and record of a particular taxpayer by the relevant tax authority is called what? Tax audit. A company, they file their return based on self-assessment. Company file return based on what? Self-assessment. Self-assessment means as a company, you are the one that will compute your tax by yourself. You are the one that will compute your capital allowance. You are the one that will compute your company income tax, education tax. You just pay and submit your basis of computation to the tax authority. Tax authority, for tax authority to know whether that your computation is correct or wrong, they have to carry out what is called tax audit. For tax authority to know whether you do not understate your income or whether you are overstating your expenses in your audited accounts submitted to them, they have to carry out what is called tax audit. Tax audit is backed by the law. The law specifically stated that every year, tax authority need to review the book and record of a taxpayer. Even in the section 60 of CETA, it is clearly stated that tax authority has a right to verify the book and record of the taxpayer from time to time as specified by the guideline stated in the law. Objective of tax audit. Why do we conduct tax audit? What are the objectives of tax audit? One of the objectives of tax audit is to enable tax auditor to, one of the objectives of tax audit is to determine whether adequate account book and record exists, to determine whether the company keep adequate account books and records. for the purpose of determining the taxable profit or loss. So it is very important. Another objective of tax audit is the tax computation submitted by the tax authority by the taxpayer to determine whether the tax computation submitted to the tax authority by the taxpayer agreed with the underlying book and record, to determine whether the tax computation submitted to the tax authority by the taxpayer agreed with the underlying books and record. Another objective of tax audit is to ensure that all applicable tax legislation have been complied with. To ensure that all applicable tax obligations have been complied with. To ensure that the company comply with all the applicable tax legislation. What are the tax legislation? Company income tax, personal income tax, petroleum profit tax, value added tax, withholding tax, Nigeria Tax Act, Nigeria Tax Administration Act, Joint Tax Act, all those ones, whether they have complied with them. We have to carry out tax audits. Tax audit too provide an avenue to educate taxpayer. During the tax audit, tax authority will educate taxpayer on how to prepare tax return, on how to compute tax, on new update in the tax law. Tax authority will educate taxpayer while doing the tax audit. This is the way they are doing it now. This way you do it is not the way. This is the new way according to the law. They will educate them. Tax audit too will discourage tax evasion. Tax evasion simply means illegal way of not paying tax by understating your income and overstating your expenses. Criminal way, illegal means of not paying your tax. Deliberate act of not paying tax. That is what tax evasion means. Tax audit discourage it. How do we detect whether a company practices tax evasion or not? It is during the time of tax audit. During the time of tax audit, we will discover whether this company, they are practicing tax evasion or not. And if tax authority detect that a company engage in tax evasion, such company will be sanctioned. They will pay penalties. They will pay interest. Another objective of tax audit, to detect and correct accounting and arithmetical error in tax return. To detect and correct accounting and arithmetical error in what? In tax return. To provide feedback to the management on various provisions of the tax law and recommend possible changes. If there is a tax law that there are some loopholes in those tax law, or there are some discrepancies in those tax law, it is during the tax audit, tax authority will hear the view of the taxpayer. This law you created, this is what cannot be applicable, this is what is going on. So tax authority will hear the view, and they will give feedback to the management of the tax authority, to the management of the revenue service. This is what the client are saying, this is what the taxpayer are saying. This is the view of taxpayer on this area, so that they can recommend to the National Assembly for possible changes. To identify cases of tax fraud and recommend for possible investigation. To identify cases of tax fraud and recommend investigation. To identify cases of tax fraud and recommend investigation. Another one, to encourage voluntary compliance. To encourage voluntary compliance is one of the objectives of tax audit. So for the sake of time, let's look at type of tax audit we have. Basically, there are two types of tax audits. There are what? Two types of tax audits. First one is called desk audit, while second one is called field audit. First one is called desk audit, while second one is called field audit. What is desk audit? Desk audit means the examination of book and record of the taxpayer based on the tax return submitted by the taxpayer and carried out in the office of tax authority. When tax authority review the book and record, the tax book and record of the taxpayer in the office of the tax authority, they did not go to the office of the taxpayer. It's from their own office. This is based on the return submitted by the taxpayer. They review it. That one is called desk audit. Anytime a company file company income tax return, tax authority will review the company income tax return. By reviewing the company income tax return in their office, they will write a letter if there's any additional assessment that company need to pay. That one is desk audit. They did not go to the premises of the taxpayer. They did not ask for a payment voucher, a sales invoice. So desk audit is normally conducted on 1 year financial statement. Take for instance now, this is 2025. We file return of 2024 in 2025 on a preceding year basis. When The return of 2024, which is filed in 2025, the account of 2024, which is filed in 2025, tax audit will review it. Once the company file it, they will determine, they will verify whether you do not understate your income or you do not overstate your expenses. All that will be carried out in the office. That is desk audit. Another type of tax audit we have, this is the most common one. It is called field audit. Field audit is more elaborate or comprehensive than desk audit, because it is the examination of book and record or review of book and record of the taxpayer in the office or in the premises of the taxpayer. This one is more comprehensive than desk audit. So this field audit, when we talk about tax audit, the tax audit we are talking about is more of field audit. Is more of field audit. Now, what are the stages involved in field tax audit? If you want to carry out field tax audit, what are the stages involved? Number one, selection of the taxpayer to be audited. Stages involved in field tax audit. Number one is selection of the taxpayer to be audited. You select the taxpayer you want to audit. You select them. It's very important. This is the taxpayer I want to audit to. You select them as a tax authority. This is the number of tax. So we are still going to dwell more on this selection of the taxpayer to be audited. Let me list the stages first. I will now be explaining them one by one. First stage is selection of the taxpayer to be audited. Second stage is preliminary review of the taxpayer file. Preliminary review of the taxpayer file. Third stage, notification of the taxpayer. Number 4 stage is pre-audit meeting, followed by immediate field audits. Number 5 stage is called post-audit meeting, while number 6 is called interim audit report. Number 7 is called post-audit review by the headquarters. While number 8, reconciliation meeting. Number 9, final audit report. Final audit report. Now, let me start from stage 1. I'm talking of stage involved in field audit. Stage 1, I said I need to select taxpayer to be audited. Now, if I want to select taxpayer to be audited, What are the criteria in which tax authority used to select taxpayer to be audited? What criteria tax authority used to select taxpayer to be audited? First, self-assessment taxpayer. Any taxpayer that files their return on a self-assessment basis, they will select them because it is not tax authority that compute their tax for them. Self-assessment means as a taxpayer, you are the one that will compute your tax by yourself. You are the one that will compute your capital allowance by yourself. You do everything by yourself. So that is self-assessment. Since you are paying your tax on self-assessment based on what you computed on your own, how do we know as a tax authority that this is right or wrong? Is by doing tax audits. Another one, taxpayer with refund claim. When a taxpayer is claiming that they have overpaid tax or they have some credit note unutilized and they want tax authority to give them back, to credit them back, to pay them back because they have overpaid tax because of excess of withholding tax credit notes. You are asking for tax refund, that tax authority should refund you on some tax you have paid which you supposed not to pay. In that case, tax authority need to review your record so that they can substantiate, they can determine whether your claims is right or wrong, whether truly you have excess tax you have paid, whether truly you have tax refund. They will scrutinize your record. By doing that, they have to do tax audit. Another criteria for selection of taxpayer to be audited: taxpayer with nil return. Taxpayer with nil return. What does this mean? This means every time the company is filing their tax return, they normally file nil return. They are telling us that they don't have turnover, they don't have expenses. Please, let's try to mute our audio. They are telling us that they do not have income, they do not have expenses. By virtue of that, they do not have any tax to pay because they did not do any activity, business during the year, or they are reporting loss. Every year, they will not pay tax. They will say they make loss. They make loss. For the last 4 years, they have been reporting loss, and they are still in business. Even if you as a company, if you are a company, you are making loss, why are you still in business? By virtue of that, that one can give tax authority a reason that this company, we need to go and check the record. We need to go and check the bank statement. We need to audit them to know whether actually they are making a loss or they are since every year.
Hello.
Hello,
Hello, can you hear me?
hello, sir.
Hello, can you hear me?
I don't know. The network is just on and off. Yes, I can hear you. The
Okay,
network
you
has
can
been
hear me clearly now.
on and off. I don't know.
On and off.
Yes, yes.
Up, but now you can hear me clearly. So let's continue.
I'm with
We
you.
are on basis of selection of
Yes,
taxpayer. We said
yes,
one of the
yes.
criteria for selecting a taxpayer to be audited is taxpayer with very low adequacy ratio. Another criteria for selecting taxpayer to be audited, tax authority can select taxpayer to be audited based on routine industry or industrial sectors. Take for instance, FRS may decide that in this 2025, most of the company we want to audit most, we want to conduct tax audit on them most, because we have received a lot of report on them that they are not paying the right tax. Every company that is into oil and gas, we must audit all the company into oil and gas in this year. It's a must. That is industry. Or every company that is into financial institution, we must audit them in this 2025. We want to know how much they are paying. We have received a notice from the president that this company, they are not paying the right tax. So it can base on that. So these are the criteria for selecting a taxpayer to be audited. They can use another criteria called random sampling. Random sampling means they can just take any company. This company, let's go and audit it. They can use criteria also from intelligence, information from intelligence units. Maybe they receive a whistleblowing information or third-party information that this company, they normally tag VAT, they don't remit. So these are the criteria for selecting a company to be audited. Let's go back to the stage. We said number one stage is for you when they want to conduct free tax audit. When tax authority want to conduct free tax audit, number one stage is to select taxpayer to be audited. Number two is preliminary review of taxpayer file. You, as a tax authority, if you want to go and audit a taxpayer, you need to review the file, the previous file, the file in the office of the tax authority. Every taxpayer have a file in the office of tax authority. You carry out the file, you look at the file, you look at the information about the company, you look at the business they are doing, you look at the board of director, you look at the last time they have conducted tax audit and what is the basis of resolution of the last tax audit. You look at the last tax clearance collected by the company. So you know about the company. You cannot just go to the company that say, I want to audit you. You must have read more about that company based on the information available to you. After that, the next thing you need to do is notification of taxpayer. Notification of what? Taxpayer. You need to notify taxpayer. You cannot just come on Monday morning. This is tax authority. We are coming to come and review your book and record. Taxpayer, they have a right not to allow you because you did not notify them. They did not prepare for you. You need to notify taxpayer at least a month before you want to conduct the tax audit. You notify them. We are coming to conduct tax audit for 5 years, so from so period to. In your notification, you will state your requirement. what are the documents you require. You will state it in the notification that in the course of the tax audit, you will need this following document to bank statement, sales invoice, purchase invoice, third-party agreement, payment vouchers. You state all the documents you need, that they should arrange them down. That is the purpose. Taxpayer too, they need to prepare that you are coming to a tax audit by arranging the record. You cannot just wake up or call taxpayer, I'm coming to come and review your record tomorrow, to come and audit you tomorrow. No. It is not done. After you have notified them, you will now have a meeting with them. That meeting is called pre-audit meeting. On the date of the tax audit, that is when you do pre-audit meeting. Before you start auditing them, you need to do a meeting with them called pre-audit meeting by introducing yourself to them. Assuming you are the head of the tax audit, you will introduce your team to them. You will tell them how many days the tax audit will take you. You will tell them what is the reason why you are doing this tax audit, that you are not which one them. You are not. Another objective of tax audit that I failed to mention is to generate revenue for government. When you read the news and they said FRS generates 21 trillion in a year, from that 21 trillion, at least 10 trillion or 15 trillion will come from tax audit. Because the general belief is most of the company, they are not paying the right tax. It is during the tax audit that they will discover additional tax that the company need to pay, and they will ensure that they pay it. So you do the periodic meeting. You tell them, they introduce you to their money. You ask for their managing director. You ask for their CFO. After the periodic meeting, you start your job immediately. You now do the audit by reviewing the record, by reviewing the bank statement, by reviewing the everything. While doing your audit, you ask for documents. If during the conduction of your audit, all the document is not provided, if all the documents are not provided and you are almost done with your audit, you will let them know that after the audit, you will still give them some little time. If any document is not available, they can send it to your office. Once they send it, you will use it as part of the basis of your conclusion of your audit. After you have finished doing your field audit, you will now arrange a meeting with them called post-audit meeting. The last day you have finished your audit, you arrange post-audit meeting with them. During the post-audit meeting, you will list out all the outstanding documents that is yet to be provided by the company to you, and you will let them know that please, so date, they must provide this document before you conclude your report. During the post-audit meeting, in case you have any question to ask on some transaction that is not clear, you can ask. After the post-audit, you now do a report called interim audit report. You send, you from the review of your record, you do your tax audit report. The first audit report you need to do is called interim audit report. You send it to the taxpayer too. Taxpayer will look at it. You say from the review of the record, you discover that they need to pay additional tax liability of 400 million. Taxpayer will say, no, we are not paying this. So, no, we have paid our tax. This one is so. When taxpayer review the interim report, they will write a letter to defense with some supporting document to object that your interim report. From before you send the interim report to the taxpayer, that interim audit report need to be reviewed by superior officer, so that what you are sending out to the taxpayer is right, is correct, so that they will not see the lapses of the tax authority too. There must be peer review. You, the team that do the audit report, you will now send the report to another person, or you send it to the headquarters. Headquarters will look at it. They'll help you fine-tune the report. When they help you fine-tune it, you can now send it to the taxpayer. Once the taxpayer receive the report, taxpayer have a right to object the report. They can object it by writing a letter of the objection to you that this is not what they are paying, and provide supporting documents to substantiate their claim that they are not owing the tax. You understand? After you receive the objection letter of the taxpayer, you can arrange a meeting. That meeting is called what? Reconciliation meeting. I want to ask a practical question, my people. During the reconciliation meeting, you are the CFO of the company, Chief Financial Officer. What do you think you can do to ensure that there is seamless reconciliation between you and the tax authority?
Provision of all the necessary supporting documents.
Okay. You have tried. Any other person? What do you think you can do? How do you reconcile with the tax authority to agree? How do you agree with the tax authority that tax authority have agreed that this is the additional tax you need to pay? How do you reconcile as the CFO? What do you suggest? How do you do that?
You they pay out now, they'll come out, though they go. Nigeria.
Win and win situation. You understand what I mean?
I understand now.
So that is the basis.
Win and win situation.
So final audit reports. During the reconciliation, you have agreed. If tax authority agree with your objection, or you agree with the objection of tax authority, based on that reconciliation meeting, tax authority will now do final audit report. Once the final audit report is out, you can now pay the additional assessments. So these are the stages involved in tax audits. You don't go and be saying, you know more about tax. You are now arguing with the tax authority during the reconciliation meeting, except you have a clean record. You can argue if you have a clean record, and if you can suspect, if you have a supporting document that can back up your claim. But if your hand is dirty already, and you know that your hand is dirty, do you understand? Try to tell them, please help me clean my hands. Do you understand my language?
Yes, sir.
So let's continue. Now, tax audit checklist. If you want to conduct, if tax authority want to conduct tax audit, what are the checklists? What are the documents? What are the information that they will extract? Tax audit checklist means before they start the tax audit, they will give you a form. Tax authority will give a taxpayer a form. That taxpayer, please fill this form. They want to use the form to know the basic information about the company. Already, please, let's try to mute our audio. Taxpayer have information about the company, but some of the information may have been changed so that they can have updated information about the company. They will give you a form called,
For sure.
please, let's try to mute our audio. They will give you a form called tax audit checklist. You fill the form before they start the tax audit. What are the content of tax audit checklist? What are the content of tax audit checklist? Name of the company is one of the content of tax audit checklist. Register address of the company, business address, date of incorporation, date of commencement of business, tax file number, nature of business, external auditor and tax consultant, banker's address, share capitals. What is the share capital of the company? Both authorized and EU share capital. It will be stated, name of the director. It will also be stated, name of the associated company and the address. If the company have any litigation, the litigation details must also be stated. The accounting year of the company, the period covered, all this must be stated in the tax audit checklist. So these are tax audit checklists. Like I said, it is a document that tax authority issued to the taxpayer that will contain some information about the taxpayer. It's a form that the taxpayer will fill so that tax authority will use it to update information about the taxpayer. The next area we need to go is called required document for federal inland revenue tax audit and investigation. What are the required documents for FRS tax audit?
Hello, sir. Hello, sir.
Number one document. Number one required document for FRS tax audit. Audited financial statement for the relevant years. Audited financial statement for the relevant year. This is very important. FRS cannot conduct tax audit on a company that don't have audited accounts. You must provide audited accounts. Before FRS want to do tax audit, they will ask you, go and bring your audited accounts. It's very important. It is your audited account that tax authority will audit to look at the income, to look at the expenses. So it's very important. Number one document, audited account for the relevant year. They will also ask management account too. Another document that they'll ask, chart of accounts. They'll also ask for your trial balance too. Audit adjustment journals too will be asked. Sales invoice file will be asked. Purchase invoice file too will be asked. Payment voucher for the bank too and petty cash payment is part of document that they'll ask you to provide. In case you are doing importation, they'll ask for your import documents. They'll ask for your fixed asset register. They will ask for your evidence of input VAT claim. They will ask for your value-added tax file. Withholding tax file too. Tax authority will ask for that. They will ask for your bank statement, company bank statement. Is one of the major requirements for tax audit. Bank statement is so important. You must provide bank statement for all your bank. Even as from next year, tax authority don't need to be asking for your bank statement again. The law have given them power that if they need a company bank statement, they don't need to write the company. The Nigeria Tax Administration Act have given them power that they don't need to write company for their bank statement. They need to contact the CBN. CBN will contact the bank. They will provide the all the bank statement relating to that company. So the new tax act, Nigeria Tax Act that is coming, I will encourage all the company. I will encourage all of us, every taxpayer. Please, let's try to comply. The cost of compliance is very low compared to penalties. There's a stiffer penalty in the new tax law. Even for those who are doing tax consultant too, when you are helping taxpayer to falsify report, to do tax evasion, to do this, to manipulate account, there is a stiffer penalty. A lot of punishment is in the new tax law. So the cost of compliance is so low compared to cost of not complying. If you not comply with the new tax law, if you are caught, the penalties and interest you are going to pay will be outweigh the actual tax you need to pay. So why can't you pay the new tax? So I always encourage people, any workshop I go, please, this new Nigeria Tax Act that was signed, let's ensure as a company we follow it. Don't let us say we want to do dubious way again. There's a lot of control that has been put in place now by FRS to reduce tax evasion. One of them, as we all know, is called e-invoicing. You have heard of e-invoicing. For a company that their turnover is about 5 billion and above, they need to have an e-invoicing. That means their software will be migrated with the FRS. As they are paying, as customer is paying them, the VAT will be deducted and remitted direct to the FRS. So, my dear fellow taxpayer, there's nowhere to hide. Though I'm not saying there there are not loopholes in the new tax law. There are some loopholes. But why looking at the new tax law is more of, if you don't comply, this is the penalties. So the penalties in the new tax law is more expensive, is more costly than not following the law. Unlike what we have before. If you don't pay tax, 10% will be added. It's not as this new tax law. Even in the new tax law, it's talking of prosecution of the taxpayer, the management. So please, let's try to comply. Another document that will be required for your tax audit, FRA tax audit, is called rent agreement. They'll ask for your rent agreement. They want to use it to know whether the rent of your office is owned by landlord or is owned by corporate organization, so that appropriate withholding tax can be imposed and leveled to the taxpayer. Another one, they will ask for your minute of board meeting. It's very important. They will ask for your minute of board meeting. They will ask for your stock register, stock inventory register, inventory reports. It's part of document that they will ask. So all these are the documents required for FRS tax audit. One of the important one, the major important one is audited account, bank statement, sales invoice, purchase invoice, audit adjustment journals. They are very important. Payment vouchers too is very important. General ledgers too is very important. Yeah. Now, let's look at documents required for state inland revenue service, state internal revenue service tax audit. What are the documents that they will ask for state internal revenue service tax audit? If they want to do tax audit for, if state tax authority like LRS want to do tax audit, what are the documents they will ask the taxpayer to provide? What are the documents that they will ask the taxpayer to provide if state tax authority want to do tax audit? Majorly, if state tax authority want to do tax audit, they want to review the company personal income tax. They want to review the company personal income tax. And they want to look at whether you deduct withholding tax on some individual contractors. So what are the documents that they will ask a company to provide if state internal revenue service want to do tax audit? The state internal revenue tax audit is called payee audit. One of the documents that they'll ask a company to provide is audited financial statements. That is number one. The trial balance and general ledgers too will be asked. They'll also ask for their staff list and their designation, the list of their staff and their relevant position. Another document required for state audit: payroll for both local staff and expatriates, schedule of company vehicle and designation, the analysis of staff costs in the audited financial statements. Evidence of registration and remittance of pension. Evidence of registration and remittance of pension will be asked. Evidence of registration and remittance of NSITF. Evidence of registration and remittance of NHF. Bank statements too, they'll ask for the company bank statements. Payment vouchers too, they'll ask for the payment vouchers. List of your contractor and suppliers will be asked. Rent agreements too will be asked. The name and address of the directors too. They'll ask, what is the name and address of the directors? Evidence of payment of your payees too will be asked. Receipt of payment of your business premises registration, they'll ask for it. Receipt of payment of your development levy for your staff will be asked. All these will be asked for state tax audit. Now, let's go. The next area we need to go. The topic is tax planning, tax audit, and tax investigation. We have looked at tax audit. We have looked at tax planning. The next area, which is the last one, is called tax investigation. What is tax investigation? How do we conduct tax investigation? What are the objectives of tax investigation? What are the differences between tax investigation and tax planning? So this is the next area we are looking at. Tax investigation is carried out when taxpayer is suspected to have committed tax fraud. Tax investigation is also review or examination of book and record of the taxpayer when there is a case of tax fraud or suspected case of tax fraud. When you know that your tax payer, the company, when they engage in tax fraud or tax evasion, when they are doing tax evasion, you now receive information about them. You do tax investigation. When this tax investigation is more elaborate than tax audit, and this tax investigation is conducted with the assistance of relevant security agency. The end result of tax investigation, tax authority will prosecute the taxpayer. Because anytime that tax investigation, we said when taxpayer is suspected to have committed tax fraud, when you committed the tax fraud, that means you can be prosecuted in the court of law. You have gone against the law. So tax investigation is more wider than tax audit. When you are doing tax audit, taxpayer did not give you record. They did not give you documents. You are asking. They did not give you audited accounts. You as a tax authority, don't fight them. Go back and write your report. What they will do, what will happen is they will transfer the file of the company from the tax audit unit to the tax investigation. Tax investigation is more elaborate and is more punishable because tax authority will not go to the premises. tax authority will go to the premises of the taxpayer while doing the investigation too. But they will not go alone. They will go with relevant security agents like Nigeria Police, Air Force, Civil Defense, Army. It depends. DSS. They will support them. This investigation unit of FRS, this is where most of the detective, forensic police, this is where they need their service. You can see that there are some police officers, they transfer their service to FRS. They work in FRS. They do not work in any department. They work in tax investigation department, where they will need to investigate the taxpayer. Question them. Because at the end of the day, what they gather will be used to tie the taxpayer to court. So tax investigation used to expose the taxpayer when they committed tax evasion or tax fraud. What are the objectives of tax investigation? Why do we do tax investigation? Number one, to detect tax evasion or other breach of tax law. To detect whether the company commit tax evasion or any other breach of tax law.
Yes.
Do you want to ask any question?
No. No. Yes. Yes.
So what is your question?
I was
Go ahead.
asking if when we were doing the auditing, the tax audit, the tax authority to go and audit only parastatal. I don't know if you understand my question.
Please repeat your question again.
It's based on all the tax authority auditing a company. So I was asking the question if it's all companies that they can go to and do the auditing, or only government parastatal company.
All private company that
Okay.
pay company income tax, education tax. You understand?
Yes, yes. Okay.
That is it. They want to audit whether they are paying the right tax.
Okay.
Do you understand me?
Yes, yes. Thank you,
Yeah.
sir.
So when you talk about parastatals ministry,
Well done,
it
sir.
is the auditor general that audit them. It is not FRS.
Okay.
Do you understand me?
Okay. Okay. So FRS audits company, a private company. So it's auditor general that audit the government company. Okay. Thank you.
Okay. You are welcome. So another objective of tax audit is to detect tax loss and recover the tax loss. To detect or to determine and recover tax loss resulting from the breach of law. Another objective is to identify and apply penalties imposed by the law for the breach of the tax law. Another objective of tax audit is to provide sufficient evidence of the breach. That evidence will be used to prosecute the offender. Another objective of tax law is to trace and locate the tax offender. Somebody that, when you are, take for instance, Let me give you a typical example of tax audit. When I was working in audit, there is one of our clients. It's a big company. This company is a Lebanese company. With the FRS discovered that this company normally add VAT on their invoice and they don't remit. One of the director of FRS went to the company sales outlet to buy an electronic. And in the invoice, in the receipt, it was shown clearly that they added 5% VAT. VAT was 5% there to the invoice. So the director look at the invoice, VAT is added. This is almost 3 million. This VAT is added. On Monday, when the director get to the office, the director now call one of the staff. Please help me check whether this company normally pay VAT as at when due. They now discover that the company did not pay any, for the last 3 years, the company did not pay 1 naira as VAT. The director now wonder, for the last 3 years, this company has not paid 1 naira. This company that I went to go and buy electronic, and in the invoice that they print out, there is a VAT of 5% added. That is the reason why that one gives the director some suspicious information. They has to set up a team for the company that let's go back again. Let's go and buy some different thing. They send like 4 different persons to go and buy items in the company. Same thing happened. VAT was charged. They said, let's wait for them in the next 2 months, whether they will remit. Maybe they just start a business. 2 months, 3 months, they did not remit. 6 months, they did not remit. After 6 months, following Monday like this, FRS have to come. The unique thing on tax investigation is, if they are coming for tax investigation, they may not inform the taxpayer. They have a right to inform. But if they are willing not to inform, they cannot inform, because taxpayer have already committed tax fraud, criminal acts. You don't need to tell criminal that you are coming to arrest him. They have to bombard the office with the police and everything. They have to lock up the company. They said, henceforth, no sales, no activities until they conclude the tax investigation. The company was locked. They sealed the company. So during the tax investigation, they have to, in the course of the tax investigation, FRS writes bank to provide the bank statement of the company for the last 7 years. They have to conduct investigation. They discover that the company is owing a sum of maybe 800 million VAT. That was 10 years ago. Even the auditor engaged with the tax auditor that was as the external auditor that engaged us. We don't have a say, too much of a say, because anything that have to involve police now, anything that have to involve tag to court, you as a tax consultant too, you don't need to say you want to help your clients. You need to use your professional due diligence. Because when you now went to say, everything has been open, there's nowhere to hide. Before you know, the major shareholder of the company have to relocate. He did not inform them. he has to leave Nigeria. When he leave Nigeria like this, so a lot of case. So that is the typical practical cases on tax investigation. Another one, another objective of tax investigation, to identify cases of tax fraud and obtain possible prosecution. Another objective of tax investigation is to generate more revenue to government. To generate more revenue to government. Now, what are the circumstances that may trigger tax investigation? What will warrant tax authority to say, we want to do tax investigation on this company? No. What are the circumstances that may trigger tax investigation? Number one, failure to register for tax. Some company, like 5 years ago, 10 years ago, this one is common. Most of the company, they will be operating, they will be doing business, and they did not register for tax. And they are doing business. But we can't, such cannot exist again. Why? Because if you are a company, if you want to go and, even if you want to open bank account now, as a company, you want to open corporate bank account, your bank, the bank will ask for your tax identification number. So that means you must have registered for tax before you can operate bank account. Like I said, the new tax law is more of compliance. One of the changes, one of the new developments in the new Tax Reform Act that will commence next year is that if a company that bank, we must report a company that engage, that receive a transaction amount that is more than maybe 25 million in their bank account. When you receive a credit alert in your bank account as a company, maybe that is more than 25 million, bank must report that transaction within 7 days to the FRS. For individuals too, as an individual, when you receive a sum of money that is more than 5 million, bank must report it to the relevant tax authorities too. So, number one circumstances is failure to register for tax. Another one, refusal to file return. You have registered for tax. You did not file VAT for the last 5 years, for the last 7 months. You are doing business. You do not file VAT return. All your VAT return in your tax promise is outstanding. Is yet to be filed. That one can make tax authority to be suspicious that maybe you are doing tax fraud, and they can request, they can set up a tax investigation exercise on your company. Another one, refusal to allow access to book and record. They want to do tax audits. The tax audit team come to your company. You have agreed that they should come so date, and they are already on ground. They want to enter your company. The security man at the gate bounce them back that no, man MD said they don't want to receive any visitor, any government official. No, you call the accountant or the CFO. The CFO is not picking your call. More than 2 hours, you are outside the gate. They do not allow you in. As a tax authority, you don't need to bother yourself. Just go back, write a report. Once they receive that report, that means the company they will transfer the file to the tax investigation. And tax investigation will come and audit the company, investigate the company. And you can't say tax investigation team should not enter your company because they are coming with police. If you say they should not enter your company, they will even seal your company. They will lock up your company by themselves because they come with law enforcement agents. They are not coming ordinarily. Tax authority will come with law enforcement agency when they want to do tax investigation. So you cannot say, you are not coming, you should not come today. We will not allow you in. No. They will enforce law on your company. If need be, they can lock up the company. They will lock it up. So refusal to allow access to book and record, or you allow the tax audit in your company. They are in your company. They want to do tax audit. They ask, give me your bank statement. You don't get. You don't have. Your audited account. We don't have. Sales invoice. You don't have. What do you now have? Everything you don't have. That means you are not serious as a company and you are doing business. You don't have. Tax authority don't need to fight with you. The tax audit team don't need to fight with you. They need to write a report. That means they will pass the file to the tax investigation. Suspicious, another condition that will warrant tax investigation. Suspicious of tax fraud. When you are there, so when they suspect that you are engaging in tax fraud, that one can be, they will do tax investigation. Denial of access to tax audit exercise. I mentioned this earlier. You deny the tax audit team to conduct tax audit exercise. They will pass your file to investigation. Another one. When your regulatory authority, like CBN, they are the one that regulate commercial bank, CBN can write FRS that, FRS, so please, there are some bank in the next 6 months, they want to merge together. Before they merge, we want to know their tax status. We want to know the tax that they are owing. Please come and audit them. This is regulatory authority. Can say, please, they discover that this company is not paying tax. CBN can write a letter that from their audit, from the exercise that they are doing on the company, the examination that they are doing on the company, they discover that this company, they are falsifying their record. CBN can write. Media tax report on the company. When there's a media report on the company that the company is engaging in tax evasion, they will do tax investigation. Or when there is a whistleblower, former staff of the company just come to FRS that, I'm the former accountant. I discovered that we normally understate their income every year. I even have some of the income we understated for some previous year in my laptop. I'm ready to help you. I'm now a born-again Christian. Maybe they have sacked the accountant. You now want to pay them back. You can go and report them. That is whistleblower. Referral from tax audit or law enforcement agency, EFCC, can refer FRS to conduct investigation on a company. ICPC can refer FRS to conduct investigation on a company. So these are the conditions that warrant for tax investigation. Now, What are the stages of tax investigation? What are the stages involved in tax investigation? How do you conduct tax investigation? What are the stages involved? Number one, surveillance. You need to carry out surveillance on the company. Surveillance means you need to carry out background check on the company. You investigate. Like I said, the surveillance that they did in the company I mentioned, I give you practical illustration. FRS sent 5 different persons to go to the company to go and buy some items. And they discovered that VAT was tagged on those items. They are now waiting whether this company will remit the VAT or not. And the company did not know that they are FRS staff. That is surveillance. FRS have been surveying the company in the last 6 months. They have been tracing them. At a time, FRS have to send one of their staff to be going to the company every day to look at how they are making sales. That is surveillance. After that, notification of the taxpayer. You need to give them notification. You can give them brief notification. But in some cases, you may not notify them, because when you notify company that you are coming for tax investigation, and if the company discover that what they have evaded, tax evasion they have engaged is too much, and what they will do, especially most of the foreigner, they will just carry their pack, their briefcase, they will go. They know that most of the money that they have evaded, they have already diverted to their foreign accounts. They will just go. So if you want to give them notification, that notification must be brief. Immediately you notify them, you can notify the relevant agency too, like immigration, NDLA, EFCC, that please be watchful of this company. Don't let the director travel out of the country. That one too is so important. Pre-investigation meeting. On the day you want to do the tax investigation, you do the pre-investigation meeting. The managing director have to be around, though. The CF to have to be around. This one is not that, it's not tax audit. You have to be, it's a must. When you do the pre-investigation, you tell them the reason why you want to do the investigation. You confirm some of the information you have gotten about the company through the engagement, through the engage in the different tax authority that they have been, tax evasion that they have been engaging on. You familiarize yourself with the company account. Another stage is evidence of investigation. You gather evidence while doing the investigation. You gather evidence, because those evidence you gather, you are going to use it in the court of law against the company. Evidence gathering is so important, because you tie the company to the law, and the law is very blind. The law is blind. If you have a video that this person raped this lady, this man raped this lady, if you take them to the court, you have to prove it again, because the man may said that video was doctored. So evidence gathering is so important. You need to convince the judge that the evidence you want to tender is real. Once you gather your evidence, you can prepare case preparation. That means you want to charge the company to court. Case preparation. From that, you arraign them to court, because they have committed a criminal offense. Based on the evidence you gather, you arraign them. While the last part is to terminate the investigation. So the next area we need to look at is, what are the differences between tax audit and tax investigation. What are the differences between tax audit and tax investigation? Tax audit is carried out on a routine basis. That means maybe every year or every five years. But in the case of tax investigation, it is carried out when there is any suspected cases of tax fraud. It can be carried out at any time. It does not have a period. Another difference, the scope of work of tax investigation is more wider than the one of what? Tax audit. Tax investigation scope of work is more wider than what? Tax audit. Tax investigation is conducted by the tax inspector that have a special training on forensic accounting. Anybody that want to do tax investigation, the tax authority that are doing tax investigation, they must have a specialized knowledge on forensic accounting. Tax investigation require a deep knowledge on forensic accounting and criminal investigation. It's not done by anybody. Another difference is the end result of tax investigation can lead to prosecution, but the end result of tax audit, that one can lead to what? Additional assessment. That is another differences. So these are the differences between tax audit and tax investigation. Now, what are the tax enforcement? How do you enforce tax law? When taxpayer committed tax fraud, when taxpayer did not pay tax, how do you enforce? Enforcement of procedure. One of the enforcement is you need to distrain. You need to issue warrant of distrain. You can distrain the taxpayer good. That means you can seize the taxpayer good. You can seize their vehicle. You can seize the good that they are selling. Another one is distrain upon land and promises. You can distrain the office. You can lock up their office, their land. You can lock it up. You can sell them. Another one is you can sue the taxpayer. You can sue them. Another enforcement procedure is you can write to CBN, to bank, for bank to lock the account. So that there will not be any outflow. So these are the tax enforcement procedure. What are the content of warrant of distraint? You want to issue warrant of distraint. Warrant of distraint means you want to lock up the tax authority office, taxpayer office, sorry. In the notice you are giving them for locking up their office, what are the contents of those warrant of distraint? The name of the officer that issued the warrant of distraint must be stated. The name of the taxpayer, the name of the company must be stated. The amount of tax level of them must be stated. The year of assessment for those tax must be stated. The amount of tax due must be stated. The signature of the FRS chairman or state tax chairman must be stated. The date of signing the warrant of district must be stated. The amount of tax outstanding must be stated. All these will be stated in the warrant of district. So, ladies and gentlemen, this is all what we have on tax audit, tax planning, tax audit, and tax investigation. Do we have any question, any issue regarding this? In the absence of no question, we can call it a day. So
Hello,
thank
sir.
you for having me.
Hello, sir.
Yes, I can
Yes.
hear you.
Okay, my name is Aisha. I've been calling you a while for your lecture notes. I just wanted to say, like, for these lectures you just delivered, you know, I can see from the heading that it's a different document. And I don't know if you're going to send this to the group also. Just like the other ones you have been treating, especially the ones that had calculation. I noticed that those ones have the solution there. But in the main combined book, the main one, it doesn't have it. So that is what I wanted you to share with us, if it's possible.
Okay, Aisha,
Yes, I've
most
been
of
calling
what
you.
I've been doing that have solution, I only send them to the group chat now. Did I not
Well,
send
no, I can't see. I think it's only 2 or 3 that I'm seeing there of the topic you have done.
which one I did
So
not
it's kind
send?
of difficult. I have to go
Which
and
one?
recheck again. I think here.
Please
But some of
recheck
those
them,
ones that have
Aisha.
to do with calculations, yes, they are not there.
They
I
are there.
will send them by chat with you again. Or maybe they can resend
Oh,
it. I don't know if somebody is seeing it. I'm not seeing it.
okay. It's well noted, Aisha. I will look
Thank
at
you,
it.
sir. Thank you,
You
sir.
are welcome. You are
I
welcome.
appreciate it.
Any other question?